The quiet drain on your future wealth. Most people think the biggest threats to their financial future are market crashes, bad luck, or not earning enough. In reality, the biggest danger is much quieter, small, seemingly harmless decisions that slowly erode your wealth over decades. Take someone like Daniel, an average investor who trusted a standard financial setup without questioning it. Over his lifetime, what looked like minor costs ended up draining more than $420,000 from his potential wealth. That's not because he made reckless decisions, but because he followed common advice that millions of people believe is correct. The truth is, many widely accepted investing ideas are not just slightly wrong, they are fundamentally flawed in ways that cost you serious money. In this breakdown, we'll go through some of the most common investing myths, explain why they sound convincing, and reveal the actual math behind them so you can avoid the same silent mistakes. Myth 1. A 1% fee doesn't matter much. At first glance, a 1% annual fee seems insignificant. If your portfolio grows 8% in a year, losing 1% feels like a small trade-off for professional help. But the reality is that fees don't just reduce your returns in a single year. They compound against you over time. Imagine starting with $250,000 and investing it for 30 years. Without fees, your investment could grow into a substantial retirement fund. Add a 1% annual fee, and suddenly your final amount shrinks dramatically, often by hundreds of thousands of dollars. This isn't because 1% is large in a single year, but because you lose not only that 1%, but also all the future growth it would have generated over decades. That tiny fee becomes one of the most expensive decisions you'll ever make. Myth 2. Stock picking is the fastest way to get rich. It's easy to believe that finding the next big stock is the key to wealth. Social media, forums, and news headlines are filled with stories of people turning small investments into fortunes overnight. But what's rarely mentioned is how rare those outcomes are. Even professional fund managers with massive research teams struggle to consistently beat the broader market over long periods. The majority fail to outperform simple index funds. If experts with advanced tools and insider-level data can't reliably win, the odds of consistently beating the market as an individual are extremely low. Instead of chasing hot tips, long-term wealth is usually built through consistency, diversification, and patience rather than lucky guesses. Myth 3. Higher risk always guarantees higher returns. Many investors assume that taking on more risk automatically leads to better rewards. While some level of risk is necessary for growth, there is a tipping point where risk stops being productive and starts becoming destructive. Highly speculative investments like penny stocks or trending digital assets often experience extreme volatility, and many eventually collapse entirely. The investments that have historically delivered strong, reliable returns are not the most exciting ones, they're the steady, diversified ones that grow over time. True investing is about managing risk intelligently, not maximizing it blindly. Myth 4. Timing the market beats staying invested. Trying to predict market highs and lows feels like a smart strategy. After all, buying low and selling high sounds simple in theory, but in practice, timing the market consistently is nearly impossible. Some of the best performing days in the market often occur immediately after major drops. If you step out of the market during downturns, you risk missing those critical recovery days. Missing even a handful of the best days over a couple of decades can cut your total returns dramatically. The investors who succeed long-term are usually not the ones who make perfect predictions, but the ones who stay invested and allow time to work in their favor. Myth 5. Selling during a crash protects you. When markets crash, fear takes over. Selling feels like a way to prevent further losses, but what actually happens is that selling locks in your losses permanently. Historically, every major downturn has eventually been followed by a recovery that not only regains losses but often reaches new highs. Investors who panic and exit the market miss that rebound. A downturn is not necessarily a sign to flee. It can be an opportunity to continue investing at lower prices. The biggest mistake is turning temporary declines into permanent financial damage. Myth 6. Real estate is always a safe bet. Real estate is often seen as one of the safest investments you can make. Property feels tangible and secure compared to stocks. However, when you adjust for inflation, the average long-term appreciation of residential property is surprisingly modest. Once you factor in maintenance, taxes, insurance, and other costs, the real return can be lower than expected. While real estate can still play a role in a diversified portfolio, assuming it will always outperform other investments is a misconception. Like any asset, its performance depends on timing, location, and overall economic conditions. Myth 7. Dividends are extra income. Dividends are often marketed as a form of passive income, giving the impression that they are free money. In reality, when a company pays a dividend, its stock price typically drops by the same amount. This means your total wealth doesn't increase, you're simply receiving part of your investment back in cash. In some cases, this can even create a tax obligation, reducing your net return. Dividends can still be useful, but understanding how they work helps avoid overestimating their benefits. Myth 8. You need a large amount to start investing. One of the most common reasons people delay investing is the belief that they need a significant amount of money to begin. This used to be somewhat true, but modern platforms now allow fractional investing, meaning you can start with very small amounts. The real advantage comes from time, not the initial size of your investment. Even modest monthly contributions can grow into substantial wealth over decades due to compounding. Waiting until you have more money often costs far more than starting small today. Myth 9. It's still early or too late to begin. Age is often used as an excuse to delay investing. Younger people think they have plenty of time, while older individuals worrying they've missed their chance. In reality, both perspectives can be harmful. Starting early allows compounding to work its magic over decades, while starting later still provides benefits compared to not investing at all. The most important factor isn't when you start, but that you start as soon as possible and remain consistent. Myth 10. More trades mean more profits. Some investors believe that frequent buying and selling increases their chances of making money. In reality, excessive trading often leads to higher fees, taxes, and emotional decision-making. Studies have shown that investors who trade less frequently often achieve better long-term results. Patience and discipline tend to outperform constant activity. Myth 11. You can rely on predictions and experts. Financial news is filled with predictions about where the market is heading next. While these forecasts sound convincing, they are rarely accurate over the long term. Markets are influenced by countless unpredictable factors, making consistent forecasting nearly impossible. Building a strategy based on predictions often leads to poor decisions, while a disciplined, long-term approach tends to be more reliable. Myth 12. Debt always prevents investing. Many people believe they must eliminate all debt before they can begin investing. While high-interest debt should be a priority, not all debt is equally harmful. In some cases, it can make sense to balance debt repayment with investing, especially if your investments are expected to grow at a higher rate than your debt costs. The key is understanding the trade-offs and making informed decisions rather than following rigid rules. Myth 13. Wealth building requires perfection. Perhaps the most damaging myth is the idea that you need perfect timing, perfect knowledge, and perfect decisions to succeed. This belief prevents many people from starting at all. In reality, successful investing is less about perfection and more about consistency. Small mistakes are inevitable, but they rarely matter as much as staying invested, continuing to contribute, and avoiding major emotional decisions. In the end, building wealth isn't about finding secret strategies or making bold predictions. It's about avoiding common mistakes, understanding how money truly grows, and giving yourself enough time for compounding to work. The difference between those who succeed and those who struggle often comes down to simple habits practiced consistently over many years. By recognizing these myths and making smarter choices, you can protect your future wealth and avoid becoming another example of how small misunderstandings lead to big Financial losses.